Hi, my name is Brian Matlock. Thank you for tuning in to this video. In this presentation, I want to give you some information that is going to serve two specific purposes. First, I want to identify and clarify the remarkable opportunity that exists in the Phoenix area in land investments. And secondly, I want to make sure you understand some of our beliefs about this market and more importantly, our strategy that we will implement as we go about executing the decisions necessary to purchase, entitle, and then resell assets for investment returns. If you're going to join us on this journey, if you're going to entrust your dollars to us as our partners, it's important to us that you understand who we are and what it is we believe and the basic approach we take to investing in land. So I recommend that you grab a notepad, a pen, jot some thoughts down as we go through this, and any questions you might have, make note of those and shoot them off to me, and I'll do my best to answer those. But let's get started. Who are we? We are Arizona Land Partners. I met my good friend Kevin Peterson the better part of 30 years ago, and I was just starting my career in real estate, and I would eventually go into apartments and single-family homes as rentals, and I built portfolios, a fairly large portfolio for myself and a handful of other clients, and focused my efforts in that regard. Kevin actually came to me soliciting management as he was starting his brokerage, but he very quickly veered out of management and into land activity. And I participated with Kevin in some of his earliest transactions. They obviously went very well, or we wouldn't have stayed in contact, but we did. And over the 3 decades that followed, he and I have been involved in numerous transactions together. I'm very happy with how those turned out. In recent years, I've made the decision that I want to shift my attention, my talents, and more specifically my resources, my dollars, into the land investment arena. I very much believe there's a great opportunity in front of us, and I'm excited about my partnership with Kevin as we pursue these things together. We've got a team of people that we work with. Kevin's son is active in the office, and a number of others, builders and other agents and brokers that we're very networked with, that provide us with some of the services that we need to acquire the assets. What is our strategy? Simply stated, it is to continue to buy strategic parcels for cash in the path of growth at the right time, adding value through entitlement. And that's something we've done historically, and it's something we want to continue to do. But I want to break apart each of those and spell that out for you so you know exactly what we're doing and why we're doing it. So the presentation is going to follow the outline in that sentence. Starts with the path of growth. We want to buy strategic parcels in the path of growth. And so the question is, what is the path of growth? The path of growth is where Phoenix is going. And as the city's growth radiates out, there are particular areas of town that are receiving the bulk of that growth. And many people have the perception that the greater Phoenix area can really grow in any direction that it wants to. And as you and I drive in and out of the city, we see huge swaths of land in every direction. Vacant, flat, what appears to be developable land in every direction outside of the city. But the thought that that's developable is actually an illusion. It's not developable land. And there are some very specific reasons why that's the case. So this is an overview shot of the greater Phoenix area. And you might not recognize the map because there's no detail here, but these are the cream area on this slide are the more densely populated parts of the greater Phoenix area. So this would be Scottsdale and Tempe down here, Phoenix proper right here, and then you get into Glendale and Peoria and so forth, and then Avondale, Tolleson, Mesa over here, Chandler and Gilbert, Tempe, up in the Fountain Hills. So anyway, the greater Phoenix area, you would see the 202 loop wrapping around like this. The 101 would come up here, and the 303 loop, so the 17 and so forth. So that gives you an idea of the greater Phoenix area. And all this land surrounding us. But, as you'll see, national forests wipe out all the acreage shaded in green. Regional parks take out these areas. State land holds all these other pieces that are colored now in blue. The federal land is colored there. Indian reservations take out a number of swaths, and then the Bureau of Land Management holds these pieces of land. And out of all that land, the only part that's developable or readily available to developers are the parcels that are remaining, which is this brown view from our satellite. Now, state land is actually theoretically available for development, and developers can bid to buy it through the state. But the bureaucratic process that you have to jump through to do that means it's ineffectively, practically not available. It's very risky for developers to do that, and so they don't do it. And so what ends up happening is state land never ends up leading growth. State land will sometimes follow growth, but it's not going to lead the growth. And so instead, you see the city expanding into areas around the state land, around these reservations, around the forest, around the Bureau of Land Management. And so growth radiates out, but it radiates out only through the available privately held land. Here are transportation corridors, and then these are the areas where Phoenix is going to continue to grow. It will move in the direction only of privately held land. And so we see the growth pushing down this Queen Creek corridor, wrapping through here. We're starting to see growth in Maricopa and other spots in the Southeast Valley. And the reason for that is builders are finding they can offer a house here, and that this commute up into these employment centers in this part of the valley is actually no longer than a person who lived in the center of Gilbert or Chandler or center of Mesa getting to these areas. The growth is moving up the I-10 in the Buckeye, Avondale area, certainly out in the Surprise, Mirage, and along the US 60 as it heads northwest. The northwest is a very active market. The hottest area of town right now is this Queen Creek corridor right up here in this part of town. Okay, this next series of slides is going to show you that historic growth. And the area I want you to focus on is this denser gray area. In 1970, the city, the greater Phoenix area had a population of 971,000. And this dense gray area represents the housing density in 1970, that 971,000. In 1975, you see those areas expanding, and our population is jumping to 1,240,000. 1980, 1,000,005. 1985, the population 1.8. 1990, 2.13, 2.6 in 1995, continues to go to 3 million, and then it grows to 3.6 million in 2005. There's no development in these areas that we had outlined with the previous slide. The city grows up to those areas, but it does not penetrate them. This is the same data, a little hard to follow because it comes from a different data source. But again, this is Phoenix, Mesa, Gilbert, Chandler. And these slides take us beyond 2005. 2010, you see the density starting to wrap down in the Southeast Valley. 2015. And now the population in 2015 was 5.2 million. And again, the point is simply to show the growth going in the direction of the privately held land. And it's going to continue to do that. And so the good news is, as investors, we can exploit that. We can look very carefully and see where the growth is headed, and we can make our purchasing decisions dependent and contingent upon our understanding of where that growth is headed. We're not just buying in the path of growth, we're also making sure we're buying at an opportunistic time. And what do we mean by that? Well, fortunately, the local economy in Phoenix is remarkably consistent to a cycle that ebbs and flows with, as I mentioned, remarkable consistency. And we're able to exploit that cycle for our investment purposes. This slide will illustrate it. This is a slide of the greater Phoenix population and the growth that that population has experienced. And these are net numbers. This slide goes back to 1975. It looks like a 45, 50-year time period. And you see the growth picking up and then backing off. And then it surges forward and then backs off. Surges forward, backs off, surges forward. And it's typically hitting a new high and then before it backs off. Now these purple bands right here are recessionary periods, national recessions. And what you see here is that the population growth peaks during non-recession periods and then has a tendency to drop down very dramatically in recession periods. And what that implies
is when the national economy is doing well, people are migrating and moving. And when the economy backs off and the growth isn't as good nationally in economic growth, people are less inclined to move and they hunker down. So Phoenix experiences this surge in flow. This was the Great Recession that we just came through in 2008-9, and obviously it had a devastating impact locally and nationally, and our growth rate then started picking back up, not having gotten back to the previous highs. Here's another slide illustrating population growth, but simply as a percentage of the existing population. And the reason I have this slide up here is to show you this number. Prior to this 2008 recession that we recently had, Phoenix averaged an annual growth rate of 3.5%. Now that's through the good times and bad times. 3.5% was this average. Okay, we've dropped down way below that and we're starting to climb back up, but we're still far below this growth average. And the reason I say that is sometimes people will say, are we entering another bubble? Well, the statistics suggest that that's probably not the case, that we're simply on a slow, steady recovery to the historic norms. The growth of the migration to the southwest of the United States is a long-term trend that virtually all economists are in agreement is going to continue into the foreseeable future. When I say that, I mean decades into the future. That's not a controversial or a debated point. That population growth will continue. Another slide showing the ebb and flow of the Phoenix economy. This is a slide showing job growth in Phoenix. And again, it goes up during the boom times. During economic downturns, job growth goes to essentially to zero. There's a slight loss of jobs in these two periods, but essentially down to zero. Surge, falls back, surge, falls back. And then, of course, in this Great Recession, we actually did have a job loss, short-lived, it lasted a couple years, and then we're back into job growth now. But that's that same cycle of Phoenix surging forward, moving back, which brings us to single-family permanents. That affects real estate. Single-family permits follow that exact same surge, and this doesn't have the recession bars superimposed on the slide, but if it did, you would see one here, you would see one here, here, and here. Now what's interesting about this, and this shows that the number of single-family permits are surging during the boom time and dropping during the recessions, which makes sense. Single-family permits are kind of a proxy measure of the confidence that housing developers have in the local economy. That is, they're going to pull lots of permits in those years when they have a great deal of confidence they can build homes and make a profit. As that confidence starts to wane, as the economy starts to weaken and demand for real estate starts to wane, they pull fewer permits. And so the growth in housing comes in that same surge and stops. The interesting thing about this slide is there was another recession right here. And yet the growth in housing permits just went right through that. And the question is why? The answer is that right here, as the market should have been backing down, the Feds started stimulating the economy through reducing those interest rates. And the net result of that, which we now know was a terrible decision, was that we built a bunch of housing the market didn't need. Natural demand should have dropped back, and then we would have had a new surge, and that would have been healthy growth. That's not what we got. We stimulated the economy, we hyper-stimulated it, and then this dramatic drop in single-family home permits was the result, which was a reflection of the fact that we grossly overbuilt and our real estate market crashed. That's reflected in the median sales price. And that's this huge bubble in values that happened here between 2005 and about bottomed in like 2009, 2010. Interestingly, single-family homes values are typically resistant to price declines, and that's why you don't see these homes going up and down in value. What you'll see is the number of transactions going down, because in those down times, sellers would simply refuse to sell. And so fewer buyers are willing to buy and prices stay flat. But what happens in a recessionary period like this is the prolonged lack of demand means that eventually sellers have to sell. They start losing them to foreclosure, or they're being moved by their job and they simply have to take what they get. And we had a runaway spiral of negativity that brought these home values down. And of course, in retrospect, what a terrible thing. For you and me at this point, though, it creates an opportunity. There's been a radical drop in the value of homes, and the market is just recovering from that. and that creates opportunity for real estate investors. This is the market cycle that Phoenix experiences over and over as it goes through the rounds that I had just outlined with those slides. There's a phase of steady development and cautious optimism. Then that becomes aggressive development and frankly too much optimism. Stage 3, we begin to overbuild our market. Investors start to get nervous, which invariably leads to a stage 4 where values might retract slightly. There's a lot of market pessimism. Sellers start to get in trouble. There's no development, and more explicitly, land is depreciating. I mentioned that single-family homes are resistant to price drops, but normally land is not so resistant, and you'll see land surge and drop in value with the development cycle much more profoundly than single-family homes. That's in a normal cycle. When you come through the tsunami of a storm that we just had, land values drop precipitously. And so land values in 2010, 11, 12 were small fractions of their previous highs. In many cases, 10 cents on the dollar is how low that land price fell. And the market has turned, it is moving back up, but there is still some residual distress in these outlying areas in the path of growth that savvy investors can exploit. And the good news is right now, the development cycle is combining with that low price to create an incredible opportunity for land purchases and acquisition. We want to buy strategic parcels, and I'm not going to spend a lot of time on the nuance of what that means, but suffice it to say this: we don't just want to buy in the path of growth, and we don't just want to buy at an opportunistic time, although both those things are incredibly important, but we need to be very careful which parcels we select and why. And that's where the decades of experience that we have as a team, and I'll give most of that credit to Kevin Peterson, the nuanced understanding of what we need to eventually deliver to a developer comes into play as we select and execute our investment decisions. We only buy for cash. So strategic parcels, path of growth, the right time, but for cash only. And there's a reason for that. Okay, if you use a bank loan to buy and hold real estate, those loans are going to have notes due on them. They're going to have interest payments due. And that can be a gun to your head if your plan doesn't exactly execute the way you wanted. And so we certainly see that the ups and downs of the market are remarkably predictable, but they're not absolutely predictable. And the market can take a delay, a left turn when you weren't expecting it. If that were to happen, we don't want to be one of those people that has a gun to our head and is forcing us to sell at an inopportune time. So we buy only for cash, so we're not one of those people. We want to buy from people in distress. We don't ever want to be that person in distress. So cash only. The good news is when you buy at the right time, the appreciation of real estate is so dramatic, you really don't need to leverage that investment in order to get very, very good returns. And so we have no intention of doing that. And then the last piece of this is we add value through entitlement. And some of you might be wondering, what is entitlement? Entitlement is the process of specifying exactly how that land is going to be developed. And you specify that by interacting with cities, with engineers, and coming up with a set of plans that are then approved for development. And it's a back and forth process, red lines and redesigns and so forth. And eventually you have a stamped approval from the cities that you can then hand to a developer. And by handing those plans to a developer, you radically raise the value of that land. Developers don't want the uncertainties and the headache and that timeline of taking the time to doing the engineering. Now the good news is doing that engineering, the soft work as far as drawings, getting them approved by the city, adds remarkable value, but in light of what you're going to eventually build on this land, or somebody's going to build on this land, the cost of it is actually relatively small. And for our purposes, that means the risk in engaging in that behavior is quite small compared to the reward that it brings to the investor. So buying land, entitling it, and selling it off to an investor is an incredible strategy for reducing risk, maximizing reward. And it's one of the reasons that so many people have made so much profit in real estate for many, many decades. What's our experience in Arizona? We've got decades of experience in this team. As I said, Kevin and I met each other when we were both in our late 20s. I got involved with single-family homes and small apartments. Kevin has spent most of his career working in exactly this field with land development. We did a number of things together, but we've watched these cycles through different lenses over that period of time. And suffice it to say, Kevin's been involved in many dozens of these kinds of transactions. I've probably been involved in 12 to 15 of them with him myself. This slide gives you an overview of the number of projects that he's been involved with. And I was involved with a number of these. In fact, some of these are properties I own now. I think this is my 53 acres on the Highway 287, a 28-acre parcel I bought with an investor here, and a 95-acre project in Casa Grande. And my point is, I'm invested in this model myself. I'm putting my own investment dollars. In fact, I'm selling my rental portfolio now to move that cash into these transactions. What are the results? Profits. That's why we do what we do. It's not a secret. It's not a new idea. It's not the least bit controversial. Strategic land investments have always created enormous profits. And when I say that, what I don't mean is that every land investment has created enormous profits. What I mean by saying always is this is something that's gone on for many, many decades and will continue for many, many more. Throughout the history of our state, throughout the history of our country, I suspect most millionaires in our country became millionaires through real estate holdings of one form or another. So this strategy creates profits. So here are some actual numbers from actual deals that we've closed on historically. And these are not meant to be cherry-picked the best deals that we could put together to present. They're really meant to show you a gamut of outcomes and the kinds of things that we're anticipating doing again as the market is heating back up and we're at a very good time. This first deal, Commercial Vistoso, is one that I actually participated in. I was an investor and bought a share along with everybody else. We bought the property for $2.366 million, sold it for $4.166 million in 3 years. That represents a 26% annualized rate of appreciation, which obviously generates a tremendous amount of profit and a lot of money to distribute. I was absolutely thrilled with my return. I would do this deal 100 times over if I could, and I know all the other investors were equally thrilled with their numbers. Here was one much smaller deal, bought for $342,000, sold 21 months later for $750,000. Another deal that I participated in was the Gilbert Air Park, purchased for $870,000, sold 7 to 8 years later for $3.3 million. Again, tremendous appreciation, tremendous profit distribution. This deal, unfortunately, was not one that I chose to participate in, and I, for obvious reasons, regret that decision very much. It was purchased for $3.3 million, sold in just 5 years for $12.6 million, about a 4 times increase. And these deals happened before the crash, and as I mentioned earlier, over the last 3 or 4 years, we've kind of picked up this activity and have been acquiring more property. Well, those have been around long enough now that the first of those are starting to turn. Here is a deal, a 3.5-acre commercial corner that Kevin did, and has 1.5 acres of that 3.5 currently in escrow. And if that closes as scheduled, and we have no reason to think it won't, the investors are going to receive their complete capital investment back plus a 23% annualized return on that capital investment, and yet the investment group will still own the 2 most valuable acres out of that 3.5-acre commercial corner. So what will that sell for? The returns on that investment are going to be outstanding there, and those are the kinds of numbers, those are the kinds of things we're seeing right now. My 95-acre piece in Casa Grande, we're preparing to do some moving on some of that property, and the numbers are just looking stellar. So it's not just stuff from pre-crash that made these kind of numbers. We're seeing these kind of numbers in stuff we've purchased more recently as well. And so this is how we handle the investor split. We're seeking funds for investors to fund our acquisition costs and the holding costs during this period of ownership.
That means whatever the asset price is, plus a budget that we'll put together to cover taxes, insurance, any other perceived holding costs that we might have, depending on the property, and then more importantly, entitlement expenses. And the way we've done this in the past, and Kevin's done throughout his career, is to gather enough money up front that we don't go back to the investors to ask for more additional funds during the holding period. And in the 12 to 15 deals I've done with Kevin, I've never had to come up with additional capital to fund any of the activity. That budget has always been sufficient. As far as I know, I don't think he's ever had to ask investors for more money to cover the taxes, insurance, and the other holding costs. We budget that carefully to be more than adequate to cover, and we will demonstrate that through transparent accounting and so forth. But we want to make sure we're not in a situation where we have to come back to investors to ask for more money. And so the split, what happens when we sell this asset? Upon resale, the investors' first priority get all their capital back, and that's the first thing that happens. We'll take the funds from the resale, give the investors every penny that they've invested as a capital investment as first priority. The next thing that happens is the investors get a 10% annual simple interest preferred return back. That means before there's any profit distribution, the investors are going to make a 10% return annualized on their investment into this deal. And then what's left from the proceeds after that is split 50% to the investment group, 50% to the management team. And what that means is this. We expect to give investors very solid and exciting returns. And historically, those returns have ranged from the mid-teens in deals that we feel like didn't go quite as well to the more common upper teens, low 20s, mid 20s, and then even things in the 30s, 40s, and 50% range. And of course, nothing is guaranteed. These are not guaranteed investments. But following this strategy, the history has been to return typically those kinds of numbers. And in a deal in which we're only distributing 10% to the investors and maybe another 4 or 5% annualized return, if you look at the mathematics, that does not put very much profit in the hands of the management team. The only reason I tell you that is not to complain about that, but is to give you some insight into our expectation, what we think is going to happen. We expect to give a much better return than that to our investors, which will then also put some money in our pockets for the effort and the time and so forth that we've been doing this. So our hope, 10% return plus a substantial return from that profit split. And if for whatever reason the investment doesn't return enough to create profits beyond that 10%, then the investors get all the money from the proceeds and the management team gets nothing. That split is meant to incentivize you, and it's meant to give you a sense of comfort and an understanding of what we believe is going to happen in these land investments. And by the way, I'm putting my money into these investments. I'm selling my rental portfolio, as I mentioned, and putting that cash into these exact investments. And my dollars earn the same return on the investment that your dollars earn. I don't get a bigger return because I'm an insider. I'm buying the exact same shares. I'm doing the exact same thing with my money. So management receives no profit prior to the investors receiving back 100% of their capital plus a 10% preferred return. And then we split the proceeds beyond that 50-50. In summary, we want to buy strategic parcels, and we know how to do that. We're going to buy them in the path of growth, and we're going to buy at opportunistic times, which we are currently in. We only buy for cash so that we're not susceptible to any miscalculations or surprises in the market. It is the right time. Now's the time to do this. Give me a call, shoot me an email, and give me some feedback on this video. Let me know if you're interested in taking the next step. Thanks a whole bunch.